High inflation, the impact of monetary policies and dollar shortages are weighing on the Naira. The IMF expects the West African currency to fall by as much as 35% this year. Dipo Ajayi, who's head of fixed income at Chapel Hill Denham, joins us with his analysis and outlook for the currency. Dipo, a pleasure. Good afternoon to you.
Yeah, good day. Thanks for having me on today.
Fantastic, Dipo. I'm keen to maybe start off by unpacking how the Nigerian economy is still digesting the reforms that came on with President Bola Tinubu, looking at the FX reforms, but also the fuel subsidy. Have those at all reached the kinds of milestones that the president and his cabinet were hoping?
Well, I think there's a lot of things that happened on the back of that decision. At the beginning of the regime of the new government, the president decided to actually remove the subsidy, which has been more like the huge burdens on the Nigerian government, and also to harmonize the FX rates. Because at that particular point in time, Naira was trading like 770 Naira to $1 in the parallel market, but was actually trading at 170 to $1 in the official market. So at that particular point in time, there has been a lot of discouragement from foreign investors to actually come into the Nigerian market. So the government decided to actually harmonize the rates and actually so as to encourage foreign investors to actually come in. But one thing that the government failed to understand is the fact that they did not do their homework very well before they made that decision. Because at that particular point in time, the president and his cabinet thought Nigeria was had about $3 billion in the reserve. But just some months into their regime, JP Morgan came out to actually dissect the reserve of Nigeria and actually published a report around the fact that the reserve is incumbent and it's only about $3.5 billion that is left on the reserve. So this became a more like put them in a point of where it was very difficult. And since then, we've been seeing the central bank coming out with different form of reforms to actually shape the market and also to actually ensure that the foreign investors are actually comfortable to come into the market. We're seeing policies like mandating banks to ensure that they maintain zero FX open position. And sincerely speaking, that sounds great to me because when you look at the books of the 5-tier 1 banks in Nigeria, as at their 9-month result, they posted about 2.7 trillion exchange gain in their financials. And but on the other side, when you look at the FMCG companies, they posted huge losses as a result of the same reason, FX loss. So it simply means that most manufacturers that actually need this FX are not getting access to it. As a result of that, most of them they've drawn down on their counterparty offshore. On their lines, they need to fund these lines. As at time they are doing that, it was at 470, but now they are funding close to 1,000 at that particular point in time. So it became a problem to most of these people. And also we see a situation whereby the central bank created more, looking at creating more like a gateway bank, where so when you actually more like they will serve like a correspondent bank. What that would do is that it helps to actually sieve out genuine FX needs that is actually passing through the radar. Also, we also have the situation whereby the central bank also talk about the IMTOs, giving them the core responsibility of maintaining for money transfer and taking that huge responsibility from banks. So banks can actually work as their agent, but it becomes more like the core responsibility of IMTO than bank. So all of this reform is to ensure that the credibility of the FX market, but it's not something that you get to see the result just immediately. And as we speak, we keep seeing actually depreciating on a daily basis because of the sentiment currently in the market. So I think that's where we are currently.
And then I must ask you, of course, Dipo, the impact this has had on inflation, because I think that's also really where it all leads to, right? The ordinary Nigerian, the ordinary person on the street really bearing the brunt of the impacts of these reforms.
Yeah, like I said that there's some things that the government did wrong because you can't just remove subsidy. We actually giving a cushion to the people. As at the time we were remove subsidy, the expectation is that okay, maybe the president will immediately increase the minimum wage to actually help to actually cushion the effect of that. Of course, the president set up committee to look at that. But I must tell you that since then, which is like 8 months ago, nothing has come forth to people. And that's one reason why you see the labor union actually coming to the street every now and then to threaten that they will go on strike. So he has been a great, he has created a great burden on Nigerians. And aside that also, the inflation figures that we're currently seeing is not more of demand push. I think it's more of cost push. Because as we see, people don't consume as the way they used to consume because there's not much money in the hand of even the real income has dropped aggressively. So it's even very difficult for people to actually consume beyond normal. But what we have seen is more like a cost push because Nigeria is battling a lot of insecurities. Farmers cannot access their farm. Even the farmers that can access their farm, the quality of the seedling is a factor. Also, the global warming crisis, a lot of flooding issue, and some of those things are some of the things affecting food. And that's one of the reasons why you see food inflation in Nigeria getting closer to what 40%. So when you look at it from that angle, it's more like the supply side than the demand side problem. So and that's one of the reasons why there's little to what the monetary policy guys can do in this regard. What you have in your confines is more like rate increase, stifle the economy with liquidity, and some of these things. If we are not very careful, that will further exacerbate the issue. Imagine you raising rates aggressively when it's not as a result of demand that's actually pushing inflation up. What it means to manufacturers is that cost of funding will go up, and there will pass through effect. And at the end of the day, what that will mean is that increase the price. So we'll come back to that same circle. So that's why the monetary policy guys and the fiscal policy guys are now trying to work together to ensure that there's that symbiotic relationship in where while the monetary policy guys are deploying their arsenal in the armory to actually curtail the aggressive inflationary pressure. Also, on the part of the fiscal policy guy, they are doing their best, ensuring that there's sanity in the country, ensuring that there's security to farmers, ensuring that some of those things that they need to do to actually help productivity, that they actually put it in the infrastructure, creating an enabling environment for business to operate, and some of these things when both parties actually now do their bits, I think it's that point that we can start seeing inflation reversing.
With that said, Dipo, the IMF and other schools of thought, they believe that it's only a matter of time. It'll be painful for a short period, but then the currency will be stronger, the Naira will recover, and that there'll be more money in the bank for the fiscus. And this is all in the best interest of Nigeria as a whole. I'm wondering if you share those sentiments, that it's only a matter of time, painful in the short term, and in the long term, everything should even be better than it was before.
Well, I think to a great extent, I actually share the view. And why I share the view is just I see Nigeria at the time as not like a Burj Khalifa without great foundation. So you can't continue to build, you can't continue to increase the number of stories in the building without ensuring there's adequate foundation. If you're not very careful, we'll continue that way. One day, the building will collapse, and when it collapses, it will be worse off. So I think what the current government is trying to do is dismantle the building, create a foundation, and ensure that the building now standing on a better foundation. Removal of subsidy is actually very tough for Nigerians, sincerely speaking. When you see cost of per liter of fuel move on by close to about 500%, it's actually very painful. But when you look at it from another perspective, a country that keeps borrowing about 7.33 trillion on a yearly basis to actually fund consumption, and the same company does not have adequate health facility, adequate educational system, adequate infrastructure, it simply means that we have been consuming those things instead of us allowing those things to actually be. And so that's why I feel that it will be painful in the short term, but in the long run, if the government are actually very sincere, that is the caveat I have around us, if the government are actually very sincere with the utilization of the saved fund to push it in infrastructure, educational sector, creating tech ops and some other things like that to actually help, and also creating an enabling environment. For me, I don't think government should actually indulge in the business of actually doing business. The key duty of business government is create an enabling environment, ensure there's security, ensure that there are policies that can actually attract funding into your economy. And I think that is what the government should actually do, and create infrastructure so that business can actually thrive.
Well, Dipo, it's all we have time for today. It's been a pleasure hearing from you, and I hope we can keep interacting in the future. Thank you for your time. That was Dipo Ajayi. He's head of fixed income at Chapel Hill Denham.